All right, today we're jumping right into the wild world of cryptocurrency. Think of this as your personal guide to this really complex but fascinating new frontier. We're going to break it down for anyone who's heard the hype but is, still a little cautious. Let's do this. So, right off the bat, you run into this kind of weird paradox. The whole idea behind cryptocurrency was to build a system that didn't need banks. But for almost everyone just starting out, where do you go? You go to a service that looks and feels, well, a lot like a bank. And wrapping your head around this contradiction is really the first, most important step to finding your way around this space safely. So, what even is a cryptocurrency? At its heart, it's just a digital token that lives on a shared network. It's designed so you can send value straight from you to someone else with no middleman. But here's the really wild part. Its value doesn't come from a government saying it's worth something. Nope. It's all about what people out there in the open market collectively decide it's worth. And this gets right back to that paradox. The big promise of crypto is decentralization. That means you and only you are in complete control of your assets. Plus, there's no single company that can just go under and take the whole system down. But the reality? Most people start by using these big, centralized exchanges. And suddenly, you're right back to trusting a company not to fail, the exact risk this whole thing was supposed to get rid of. So you're probably wondering, how does any of this work without a central boss keeping everything in line? How is it not just total chaos? Well, the answer is the incredible engine running under the hood, blockchain technology. Let's dig into how this thing actually builds trust without needing a bank or a government. The easiest way to picture a blockchain is like a giant, shared digital notebook. A copy of this notebook is given to thousands of computers all over the world. Everyone can see what's written in it, but, and this is the magic part, once a transaction is written down, it can never, ever be erased or changed. That's what makes it basically impossible to cheat the system and creates a record that everyone can trust. And the way it works is just genius. When you make a transaction, it gets bundled up with a bunch of others into a block. That new block is then digitally changed to the one that came before it, creating this super strong, unbreakable link. Once the whole network agrees it's legit, it's locked into that shared notebook forever. If someone wanted to go back and change something, they'd have to redo all the work for every single block that came after it. It's practically impossible. Okay, so we've got the tech basics down. Now, let's talk about the two biggest names in the game, Bitcoin and Ethereum. You hear them mentioned together all the time, right? But the thing is, they were actually built to do totally different things. So here's the big difference. Bitcoin was created with one main goal, to be a new kind of money, a peer-to-peer electronic cash system. Over time, a lot of people started seeing it more like digital gold. Ethereum, though, that was way more ambitious. The vision was to create a single global computer that anyone could use to build applications that couldn't be shut down. And you can see how those different goals play out right here in the details. Just look at the supply cap. Bitcoin has a hard limit of 21 million coins, ever. That's a huge part of its digital gold story. It's scarce. Ethereum doesn't have a fixed cap because it needs to be flexible for all those applications. And its key tech is the smart contract, which is like a building block for programs. These aren't just tiny details. They lead to completely different ecosystems. Okay, enough theory, let's get practical. How do you actually step into this world? And way more importantly, how do you make sure you're setting yourself up safely right from the very beginning? If you remember just one thing from this entire explainer, please let it be this. Not your keys, not your coins. It's the golden rule of crypto. It means that if you don't personally control the secret password, the private key, to your funds, then you don't really own them. Simple as that. If your crypto is just sitting on an exchange, they have the keys, and you're just trusting them. True ownership means holding your own keys. So how do you hold your own keys? With a wallet. There are basically two kinds. Hot wallets are apps on your phone or computer. They're always online, which makes them super convenient for small, everyday transactions. But it also makes them a target for hackers. Cold wallets, on the other hand, are little physical devices that keep your keys completely offline. They are, without a doubt, the most secure way to store any serious amount of crypto for the long haul. We've talked about being safe, but let's be real for a second. We have to talk about the dangers. This space can be like the Wild West, and if you don't understand the hazards, you're gonna have a bad time. These right here are the classic rookie mistakes. First, jumping in without doing your own research. That's a recipe for disaster. Then there's letting your emotions take over. Seeing a price spike and getting that fear of missing out, or FOMO and buying at the top, or panic selling when things dip. But the biggest rule of all, Never, ever invest more than you are truly okay with losing. And finally, ignoring security, that's just not an option. Now, it's not just the market you have to worry about. There are people actively trying to steal from you. Think of this as your scam spotting guide. A huge red flag. If anyone from a support team or government agency ever asks you to send them crypto to fix a problem, it is 100% a scam. And for this other really nasty one they call pig butchering, if a new friend you met online starts giving you amazing investment advice, run. Seriously, burn these red flags into your brain. Okay, so after all that talk about risks and scams, it is so important that we shift gears here. Because for a lot of us in places with stable banks, crypto can seem like just a risky bet. But for millions of people in other parts of the world, it's not a casino, it's a tool. It's a utility that solves massive real-world problems. And Kenya is the perfect example. And this number, 43%, this really tells the whole story. That's how much of the crypto being used in sub-Saharan Africa is in stablecoins, which are tokens designed to hold a steady value, like $1. This proves it's not mostly about wild speculation. For so many people, it's about protecting their savings from a currency that's losing value. It's about sending money to family across borders without huge fees. It's a lifeline. And that really brings us to the final question, doesn't it? Is cryptocurrency just a giant speculative bubble, or is it an absolutely vital tool for the future of finance? And as we've seen, the answer really is it depends on who you are and where you live. For some, it's a high-risk adventure. For others, it's a fundamental necessity. The real journey isn't about finding a single answer. It's about continuing to learn and deciding for yourself what role you think this powerful technology is going to play in all of our futures.